A very good morning to all of you students. Today we will be starting our discussion on the topic of business valuation. Good morning, Mansha, Shruti, Satish, Guram. Good morning, everyone. So students, business valuation as a topic is a very dynamic topic. Reason being, there are no fixed there are no fixed boundaries within which business valuation revolves. For example, there are different methods, and within those methods also there are different sub methods. And while we talk about valuation, so it can be a mix of two methods also, or it can be a straightforward single method as well. So we have to really not stick ourselves to only to the concepts, but even to the factual things that would be mentioned in the questions. So for this specific topic, students, we will just cover quickly the basic understanding of how a business is valued. Then we will cover up certain questions to form up that understanding. So let us start, students. So for business valuation, now if you see your entire previous knowledge, even of the CA Inter of financial management will be used. And even till now in CA final, whatever you have studied, so you will have to link all those concepts and then we will be able to justify or let's say understand the business valuation. Business valuation, students. Okay. Now, first of all, to start with, we just need to understand some of the basic concepts. First of all is the present value concept. Present value, students, we have studied in derivatives, specifically present value and future value. Remember, wherein we were trying to do the valuation of a forward or a future, wherein we used the present value and future value principles. We also studied about the continuous compounding here, correct? So we have to keep in mind, how do we arrive at a present value? How do we arrive at a future value? Which I think all of us know, right? So I'm not repeating it, correct? But what I'm trying to say is that this present value concept will be used, okay, in the business valuation. Second part is internal rate of return, IRR. In case of internal rate of return, students, what we do, the present value of cash outflow is equal to the present value of cash inflow. So this equation holds true at which rate? That rate is called as internal rate of return. In other words, at internal rate of return, you will be at NPV 0, correct? From your previous understanding on the capital budgeting, students, correct? And higher the IRR means better the return, okay? Because IRR will equate the cash outflows to cash inflows at a present value level. Now, third part is ROI, return on investment, which was very easy, students. Whatever amount we have invested on that, whatever return are we getting, that is called as return on investments. Shailesh, good morning. Then we also discussed about in our CA Inter about the Gordon model in dividend decision, students. You would all recall there was a discussion on the Gordon's model. That was also called as Gordon's growth model, in which we said that perpetually there will be a growth. So Gordon's growth, what did it suggested? Dividend divided by KE minus G, correct? Can you recall all this? So wherein we said that if we divide dividend by KE, which is the cost of equity, G, which is growth, Growth, how it was calculated? Growth is equal to B into R. B was retention amount, retention ratio. Whatever you earn out of that, how much you retain. Because you will grow on that amount which you retain. Whatever you have paid it off as a dividend will not be counted for growth. R is equal to ROI, return on investment, that we discussed above. So, using this, we were trying to find out the price of the shares, or let's say the value of the company. Correct? So, all these things will be used. Viraj, good morning. Mansha, NPV is better than IRR in maximizing the shareholder's wealth. Yes, Mansha. See, NPV has a different utility. NPV tells you that if it is positive, then you should accept. But on the other hand, if you have cost of equity and IRR, so if IRR is higher than cost of equity, then only you should accept. Okay. If IRR is higher than cost of equity, then only you should accept. That's the two different objectives of IRR and this. I hope this is clear, students. Then next part was on the terminal value. While valuing anything, let's say any business, any company, what we do is generally there are two terms. One is the explicit period and second is the terminal value. Explicit period is for the period which we have individual forecasts. Let's say we are valuing a business, we do 5 years forecast, then for the 6th year, we assign a terminal value. Terminal value means that we cannot forecast the estimates till the perpetuity, right? So we need to take a present value of all the future cash flows as on the 5th year. That is called as terminal value. Okay. So you would all recall in the capital budgeting decisions, NCA Inter, it was used very much, the terminal value concept. Okay. Similarly, in the business valuation also, we will use the terminal value. Okay, students. Then I hope all of you remember what is meant by WACC, weighted average cost of capital. Can you tell me, students, what do you mean by WACC? What is your understanding on WACC? Come on. What is your understanding on WACC, students? Come on, tell me. Yes, students, tell me. Mansha, Shruti, Satish, Guram, Shailesh, Viraj, all of you who have joined, please let me know. What do you mean by WACC? What is your understanding on WACC? It's a very simple thing. The name itself tells it. Very good, Satish. You are right. Mansha, okay. Any other answer, Satish? Sorry, has given the right answer. Yes, Shruti, very good. Yes, very nice. Shruti and Shailesh, yes, both of you are correct. So, weighted average of cost of capital means whatever capital structure a company follows, okay, for all the capital structures, there is a cost involved, right? Let's say if you read a balance sheet, I'm just putting it in a T format, and here it is equities and liabilities. Here it is equity, here it is debt, here it is, let's say, preference shares, and so on, right? So equity shareholders will expect some return, or let's say there is a cost involved for equity, which is called as KE, that we discussed here, cost of equity, correct? This is the cost of equity. Similarly, for debt instruments, the debt instruments holder will ask for cost of debt, which is KD. Then similarly for preference shares, I'm right denoting it by KP. Okay. And the weighted average of all this will come to WACC, which is overall cost of capital. Now, students, one more point. This overall cost of capital is in relation to the expectation from these different people. Okay. Why? Because we are not talking about how much actually business is able to give them. We are not talking about that. These are the market expectations from these people who have contributed such capital, students. Yes, Kusuma, you are also right. Getting my point? So it is always from the market perspective, students, always from the investor's perspective, the people who have invested equity, debt, or preference shares, the cost of equity, cost of debt, cost of preference share is from their viewpoint. Okay, from the market viewpoint. Because from the company's viewpoint, we have return on equity, return on investment, or let's say return on equity, or return on total assets. Correct. That will give you that actually business, how much is able to give you a return, or similarly IRR for that matter. Correct. You are understand you. I hope you are able to understand my point. Correct. Because this will make a big difference in how do we value the business. Okay. Now let's move ahead. Let's come to now, students, what are the different approaches to value an enterprise? Okay. What are they? First of all, let's talk about asset-based approach. Okay, very good. So, in case of a asset-based approach, now students, if you see, for what, let's say today I have a business, okay, and if I want to sell it, for what thing exactly in my business, some other people will pay me. What is that underlying of that business? The underlying of that business is the assets, are the assets that I have. Assets minus liabilities, of course, whatever I have the net assets position, for that, the people will pay me. Okay, students. So whatever assets I have, for that, people will pay me. Now, what should be the right value of those assets? See, one thing is understood that while assuming a liability for any business, we need to really see what is the underlying asset. Now, what is the right value of that asset? Who will determine that? How will it be determined? Those questions will come, right? Now, there are three ways. There are three ways by which the underlying asset can also be valued. First one, net assets value, NAV, students. This is the most popular, or let's say the easiest approach in the asset-based approach. What do you mean by net assets value, students? NAV. So NAV, students, it means that whatever is your book value of all your assets minus your debt will give you the net assets value. So can I say that NAV is equal to fixed assets? Now this term, instead of fixed assets, we call as property, plant and equipment as per the financial reporting terminology, plus net current assets. Net current assets means net of liabilities, okay, minus long-term debt. This is called as NAV, students. Yes, assets minus liabilities, Shruti. And this is all book value approach. Okay. So in this, we use the historical cost, or I can say book value, because the balance sheet will be carrying the value of these assets and liabilities. So we will take the same assets and liabilities, arrive at the net assets value. I will write or here so that there is no confusion, that there is no minus here. It is or, okay? Historical cost or book value. Okay. Then second method under asset-based approach is net realizable value. So students, net realizable value means today, if I go and liquidate my assets and realize the amounts, what will be that realizable value be? Let's say I have a debtor of 10 lakhs, right? But I know out of that 10 lakhs, I will not be able to realize 5% because 5% is representing to a debtor, right? Who I know very well that will not be able to pay me. I will not be able to realize because the bankruptcy is near, or let's say there is no intention to pay. In such a case, my net realizable value will be 10 lakh minus 5% of 10 lakh, which is 9 lakh 50,000. Okay. So in a way, net realizable value translates the book values to the ultimate realization values. So it will adjust the book values to some extent to the reality that is there. Okay. This is also called as the liquidation value or adjusted book value, students. So again, in this case, we take the net realizable value of all the assets and liabilities. Similarly, fixed assets, net current assets minus long-term debt. So I'm just replacing, instead of book value, the net realizable value is taken. Okay. The net realizable value is taken, students. Simple, and the formula remains same. Third, replaceable value. So for replaceable value, students, replaceable value, students, what do we mean? And what is the difference between replaceable and realizable? Replaceable value is generally used for your fixed assets, correct? Because what happens, let's say you purchased a machinery and that machinery can be used for 10 years. After 3 years of use, you want to replace that machinery. Then we need to determine what is the replaceable value for that machinery after 3 years. which is having a similar condition, similar output, similar capacity, everything is similar. But what is the current replacement cost? That is called as replaceable value, students. I hope this is clear. It is not actually if I'm going to sell in the market, how much I get as a realization. I'm not talking about that. I'm talking about that if I want to replace it today, what would be the replaceable, what would be the cost of that replacement that I need to do? Suraj, present value of cash outflow minus initial outlay. Uh, yes, Suraj, present value of cash outflow is what your initial outlay is. Is that what you're trying to say, Suraj? So, replaceable value, students, understood? Replaceable value is the same condition of the machinery, the same balance useful life of the machinery. If I want to replace it today, so how I'm going to be, what is the value that I'm going to be charged? Okay. Now, see students, the asset-based approach, whether it is net assets value, net realizable value, or replaceable value, is always taking into account the transactions that has already happened. It is not forward-looking, correct? So, asset-based approach is not forward-looking, students, correct? It always goes through the past and tells you that these are the recorded assets and liabilities. Now you value it as per NAV, as per realizable value, or as per replaceable values. Where is the question when it comes to the future increase in the profitability, future, the correct, let's say the correct pricing of the business, or let's say the correct valuation of the business from the futuristic perspective, because in futures, a lot of things can change compared to what we have. Let's say future, we are expecting a good amount of growth that is not reflected in these values. So then there is another approach that is called as income-based approach, students. Okay, so this was A. Let me go to B now. Okay, what are these income-based approach? Now, in this income-based approach, the projections of the future is taken, students. Or let's say we try to arrive at the value of the business basis the income that we are expecting to earn. Okay. So what we do is, first of all, we calculate the future maintainable profits. Okay. We calculate the future maintainable profits. What do you mean by future maintainable profits? So let's say today I'm earning 1 lakh. Okay. But in future, out of this 1 lakh, 20,000 I was earning as a one-time income. So I will not earn 20,000 in future. So that means only 80,000 is my future maintainable profit. Yes. Now, I also know that there is a new product development that is going on, and I will launch that new product very soon. With that, I will be getting another 25,000 extra as my income. So in that case, my future maintainable profits becomes 1,05,000 instead of the current approach of 1 lakh, students. I hope it is clear. Okay, students. So future maintainable profits is basically what amount of profits I can expect to continue in future. Okay. Then once I've calculated the future maintainable profit, then I will use the PE multiple or capitalization rate, whatever is available or whatever is required in the question to calculate the value of the business. Now, what is this PE multiple and what is this capitalization rate? So students, PE multiple, as all of you know, PE multiple, as all of you know, is what? Price divided by earnings. So this is one multiple which tell me that for 1 rupee of earning, how much price is quoted in the market. If you really have to see this P multiple, what you can do is you just see what is the EPS of a company as per the annual number. And whatever is the share price appearing in the share market, take that and arrive at the P multiple. Okay, for example, let's say the share market 1400 rupees is the share price. And let's say the earnings per share represented by the company in their annual financial statements is 140. So broadly, I'm telling broadly, okay. So it will be 10 times. So that it means for every rupee one earned, market will value this as 10 times of 1 rupee earned. Okay, so it will translate into the valuation of the business. So whatever is our future maintainable profits, because EPS is what? Earnings per share. So similarly, FMP, future maintainable profit, will be converted into earnings per share, and then it will be converted to the value, or let's say the price of the equity share using the PE multiple, students. No, Mansha, there is no need to consider probabilities. Okay. In this case, there is no probability, but if in question it tells you, then you can consider probabilities. Okay. Rasha Haris is saying it's cost of capital where equity and debt together appears. I think for Rasha, you would be saying it for WAC if I'm not wrong. Maybe this you would be saying, correct? Kusuma, yes, MPS by EPS. Perfect. Okay, P multiple is understood. Then let's come to the capitalization rate. Now, the capitalization rate sometimes is also called as cost of equity. Okay, this is generally called as cost of equity. Let's say it is 14%. So 14% is the cost of equity. Okay, then whatever is our profits, we will divide it by 14% to arrive at the value. Okay. So earnings divided by capitalization rate will be our value. Simple. Okay, students. So this is all about income-based approach. In this, first we try to calculate the future maintainable profit. Correct? What is the we will not see what is the current state of profits. We will see that how much of that profits are sustainable, how much we can rely upon in future, and then we apply P multiple or capitalization rate, whichever way it is given in the question. Next one is cash flow based approach. In cash flow based approach, students, what happens? This is the ultimate method, and this is a very useful method which is used in a lot of valuing techniques. Okay. Even P multiple or capitalization rate is also used today, students, because as I told you, nobody can tell you a single value. Everyone will tell you that what is the minimum value, what is the maximum value. Now it is up to you how much you negotiate between that minimum and maximum to the other party. Okay. So the cash flow based approach what it does, it says that it is based on the discounted free cash flow, DC, DFCF, okay, discounted free cash flows. Now, students, if you see discounted is something in that we will use the present value concepts. Correct? It is easy. Now, what do you mean by free cash flow, students? What do you mean by free cash flows? Can anyone attempt this? What is exactly meant by free cash flow? I've opened it for everyone to put their thoughts. See, cash flow we understood. Cash flow is your regular cash inflow, regular cash outflow. But what is the free cash flow? If anyone wants to share their thoughts. Yes, students, tell me. Not involving costs. Okay, Suraj is saying not involving costs. Okay. Anyone else? Are there other thoughts too? Okay, Mansha is saying less depreciation, less appro. Kusuma is saying like risk free. Okay. So free cash flow. Satish, it's free cash flow. Discounted free cash flow. Cash flow minus depreciation minus tax. Okay, Shruti. Okay, well attempted, students. So free cash flow, students, means cash flow from operations less capex outflow. Generally, we call it as free cash flow. In the if you read any financial statements of a company, you will know what is the cash flow from operations, right? From that, if you reduce the capital expenditure, you will arrive at the free cash flow. Generally, okay? Yes, Gurram. Free cash flow means not having any expenses to deduct. That means expenses are already deducted. Okay. No. So free cash flow means operating cash flow less depreciation. No. Depreciation is not a cash item. Depreciation can never be reduced from a free cash flow, right? Free cash flow means the cash flow from operations, whatever cash earnings you are able to do from your operations minus the capex outflow, students. Okay, that is called as free cash flow. Now, now we use, first of all, the discounted free cash flow method. Now, in that, we calculate the free cash flows first for the future periods and then arrive at the discounted part and take the present value of that to arrive at the discounted free cash flow. Okay. And in this also, the terminal value plays a role because free cash flows, as I told you that, let's say you are sitting on 0th period, 1, 2, 3, and 4. Let's say you can estimate the free cash flows for 1 year, second year, third year, and fourth year. Now, what after fourth year? Terminal value. Correct, because you cannot go on perpetuity for estimating this. You will have to restrict yourself to some explicit period. So this is called as explicit period. And this is called as terminal value. Take present value of explicit period related free cash flows and take present value of terminal value. And you will arrive at the, and you just do a total, you will arrive at the business value. Okay. So these are the three broad-based models: asset-based, earnings-based, and sorry, asset-based, income-based, income or earning-based, whatever you want to say. And third one is the cash flow-based. So there are three things, students, right? The simple way to remember: in your financial statements, you have cash flow, you have balance sheet, and you have P&L. So the first approach, asset-based, is a balance sheet approach. The second approach, income approach, is a P&L approach, wherein we take the earnings and then arrive at the future maintainable amount and do the calculations accordingly. And third approach is a cash flow approach, which is more importantly based on the cash flows that we generate. Okay, easy. Now let's come to the question, students. Okay, let's come to the question. Sun Limited. This is question number 1 from the assignment that has been uploaded, students. See, now one word of caution, students. These questions have lot of information. These give you lot of data points, right? Because there are multiple methods involved. There are multiple inputs that goes into those methods, right? So we need to understand that which input will be used in which method. So we have to clearly dissect the information in such a manner that we don't create complexity. Okay. We have to keep things simple. So Sun Limited recently made a profit of rupees 200 crore. So first of all, we have been given something about profit. Okay. We can keep on registering in our mind that what all things are given, and paid out rupees 80 crore, slightly higher than the average paid in the industry to which it pertains. Paid out 80 crore means dividend is paid out 80 crore, earnings is 200 crore. The average PE ratio of the industry is 9. They have also given us the PE ratio. Students, I have a question. Till now, we have been given earnings. We have been given dividend. We have been given PE ratio 9. So can I apply the PE ratio on dividend to arrive at the value? Come on, students, tell me. Till now, either yes or no, you need to tell us whether I can apply PE ratio on dividend to arrive at the value. 9 into 80, can I do that? Yes or no? Okay, Mansha has responded. I request everyone else also to put your thoughts, students. The question is simple. Can I apply PE ratio on dividend amount to arrive at the value? I'm expecting more answers, students. If all of you will answer, then definitely a lot of things will get cleared. Don't think whether it is right or wrong. Please answer. Suraj. Okay, Suraj and Mansha have answered. I will not reveal what they have answered. But I can tell you that this is not the right answer, Mansha and Suraj. So, yes, students, yes or no, whether I can apply PE ratio on dividend to calculate the value. Very good. Now I'm getting more answers. Shruti, Shailesh, Kusuma has not. Maybe yes, sir. Okay. So I will say Shruti, Shailesh, Prashant, and Mohammad Abdul Rahim. All of you are correct. Uh, the reason is, how is PE ratio calculated, students? Price divided by earnings. It gives me, let's say, 10 times. I have to multiply for arriving at price 10 times into earnings, not dividend, then only I will be able to arrive at the price, right? If you reverse the equation. Yes, Satish and Gurram. Perfect. So, what is PE ratio? This, let's say, right? So, price will become earnings into 10. It will never become dividend into 10. Okay? Perfect. Understanding clear? The estimated beta of Sun Limited is 1.2. They have given us the beta as well. What is beta, students? So we will cover lot of concepts through the questions itself, as I told you, because this will knit everything that you have learned till now from your CA Inter as well as final. Okay. So first of all, students, tell me what is beta? Beta is the sensitivity of return of which company? Sun Limited here, with respect to the sensitivity, with respect to the, let's say, changes in return of market. Beta is sensitivity of changes in return, I can say. Okay. So beta is sensitivity of changes of return of Sun Limited with respect to that of the market. That means percentage change in return of Sun Limited divided by percentage change in return of that market. Agreed, students? Yes, very nice. Shailesh is saying systematic risk from portfolio management. Okay. It's actually not systematic risk. It's used to calculate systematic risk. Yes, Shailesh. Perfect. Good to see. Guram is saying sensitivity of P by E. Yes. Satish is saying beta means what is the change in security return for every change in the market return. Very good. Yes. All of you are correct. Beta is understood. Now Suraj is asking, but sir, earnings will include dividend to shareholders. Yet, yes, Suraj, earnings will include dividend. But what about this balance 120? So if you only take 80 into 9, that means you are saying that I am multiplying the PE ratio only to dividend amount, which will be wrong. Because how is 10 times derived? See, had it been price by dividend is equal to 10, I would have told you that, okay, for calculating the price, you multiply 10 into dividend. But the original formula is price divided by earnings, and earnings are higher than dividend in my example or in this question. Okay. That's why I'm saying that you cannot multiply in dividend the PE ratio to arrive at the price. You have to multiply P ratio in earnings to arrive at the pricing. Okay. The estimated beta of Sun Limited is 1.2. As per the balance sheet of Sun Limited, the shareholders fund is 450 crore. What is the shareholders fund, students? The one that is equity and other equity. Okay. Because if you see in the balance sheet, in the top it's shareholders fund, then it comes the debt, then comes the non-current liability, then comes the current liability. Okay. And they've also told us that the number of shares is 10 crore. In case the company is liquidated, building would fetch 200 crore more than the book value and stock will realize 50 crores less. So something will be sold at a higher rate, something will be sold at a lower rate. Okay. The other data for the industry is as follows. The projected dividend growth, risk-free rate of return, market rate of return. So students, wherever you get a combination of this and beta, one thing is very clear, somewhere or the other, we might need to use capital asset pricing model, CAPM. Okay. Because you have been given risk-free rate of return, you have been given market rate of return, you have been given beta. That means we have to arrive at the cost of equity using the capital asset pricing model. Now they're asking us to calculate the valuation of Sun Limited using PE ratio, dividend, book value, and net realizable value. Now, if you see students, we have discussed all these things. Suraj is saying share cap plus RS is shareholders fund. Yes, very good. Reserves and surplus plus share capital is the Kusuma. We can have KE. Yes, Kusuma, we can calculate KE. Now, without wasting time, solution using PE ratio. Okay, students. Now, first of all, for calculating price using PE ratio, can we use this formula earnings multiplied by PE ratio? Correct? So, what is the earnings? 200 crores. What is the PE ratio? They've also given us the PE ratio as 9. So, the price becomes, sorry, 1800 crore. Sorry. Okay, students. So, the price becomes 1800 crore. That means for every 1 rupee earned, the people are ready to give you 9 times as the value. Okay. And this is a very important valuation technique. This gives you the mostly the upper range, that what is the maximum amount that a person can give you. Okay, students. Now let's move to the next part, dividend growth model. Now, dividend growth model, students, as I told you, what was it? Using Gordon's formula, dividend 1 divided by KE minus growth. So, wherein dividend 1 is equal to dividend expected to be paid at year 1. KE is equal to cost of capital and G is equal to growth of dividend. Okay. So, first of all, students, D1 is equal to D0 1 plus growth rate. Correct? Because we have been given 80 crores as D0, which is the today's dividend. Because it said that recently made a profit and it is expecting 80 crores. So that is D0, that means. Okay. Sorry. Okay. So that means this is D0. So D1 will be equal to 80 crores 1 plus 4%. Correct? Why? Because 4% is the 4% is the projected dividend growth, students. Okay. KE will be, now all of you are masters in capital asset pricing model. Yes, Mancha, 1800 crore is the market cap that we have calculated above. Now for capital asset pricing model, all of you know what is the formula. Risk-free rate of return plus beta RM minus RF. So what is the risk-free rate of return, students? 6% plus beta of 1.2. RM is 11% and risk-free rate of return is 6%. So this gives us 12% as KE. Growth already is 4% that is given in the question. So can we find out the price using, or let's say the valuation? Here we're talking about valuation, it's not price because what we are not using per share amount, we are using the total value. So value will be 80 crores multiplied by 1.04 divided by 12% minus 4%. So this comes as 1040 crores. So the value is equal to 1040 crores using the dividend growth model, which is also called as Gordon's model, students. I hope this is clear. Okay, so Gurram, expecting dividend means D1 because, see, first of all, the question is said that recently 200 crore is done and out of that 200 crore, 80 crore will be paid. That means, first of all, it is a information as on today. While calculating the value as on today, we need dividend 1 year from now. Hence, we have taken 80 crores 1 plus 4%. Okay. Yes, Mancha, it is 12%. Then next value, next method of value is what? Book value. Book value we have been straight away given, students. The shareholder fund is the book value. Okay, because what you do, fixed assets minus long-term debt plus net current assets, which is also equal to the shareholders fund, students. Okay. So C part, we have to do nothing. As per book value, the value of business is rupees 450 crores. Then comes to the last part, which is net realizable value. So net realizable value. Now, students, we have not been given the overall net realizable value. We have been only given two incremental adjustments, right? So let's take the book value, first of all, of 450 crores plus incremental amount due to building. Correct? It was mentioned that building will be sold at a higher amount, which is 200 crore. Minus realization loss on stock. That was how much? I think 50 crores. Correct? So this becomes 600 crore. 450 minus 50, 400 plus 200 is 600 crores. So this is the Net realizable value of the business students. Easy and simple, students. The questions are, should we move ahead? Let's move ahead to the next question. Question number 2, students. Strong Limited, an all equity financed conglomerate, is in the need to borrow rupees 2000 crore to finance expansion of its current core operations. So there is a company which is currently all equity financed. It is looking out to borrow, or it is in a need of money of 2000 crore. Okay. However, SL is susceptible to raise the amount from the market. The CFO has suggested for divesting one of the two non-prime units to reduce the overall borrowings from the market. Now, see, students, what is the bigger problem with this company? The bigger problem with this company is that they need amount to be borrowed, but they don't want to go borrowing, or they don't want to raise the amount from market. What they want to do is they have two non-prime units. Non-prime units means which are not under the radar, or let's say not under the focus, which they can sell, and they can realize the amounts to do the expansion of its current core operations. Okay, the following data after internal due diligence has been placed for the consideration of the board. So this is unit number 1 actually, students, and the other one is unit number 2. Reported profit after tax is what they have given. Extraordinary gains, extraordinary losses. What do we mean by something called as extraordinary gain or losses? Extraordinary gain or losses means that which are not going to continue in future, correct? Which cannot be continue in future. These are just one-time gain or loss. Expected profit from the launch of new product. This will be an incremental amount from year onwards. Price earnings ratio, corporate tax rate. You are required to advise the board on the following: the price at which the units can be divested. First of all, students, basis whatever information that has been given to you, which method you think you can apply? The price at which units can be divested, which method do you think you can apply? Students, come on, tell me. Basis whatever information is given to you, tell me whether this we can apply asset based, income based, or cash flow based. A, I, or C. A is asset based, I is income based, C is cash flow based, students. Come on, students, tell me. Just think and then answer. Okay, let's go to replaceable value, realizable value, or NAV value later on. But first, I'm saying there are three broad methods, right? Asset based, income based, and cash flow based. What do you think, basis the information that is given to you, whether you will apply asset based, income based, or cash flow based, students? Now, within asset based, we have a replaceable value, realizable value, NAV that we will come to later. Very good, Prashant, Mohammed Abdul Rahim, Gurram. Very good. All of you are correct. I am not revealing the answer again. I request everyone else also to please contribute, to please answer. Think and then answer, students. See, because the question has not told you any specific method to be applied. That's the reason I am pressing on this. Very good. Jyoti, Suraj, Mansha, Shailesh, all of you are correct. I think everyone is thinking on the correct lines. Very good. It's 100% correct. So this is income-based students. Because we have been given PE ratio, we have been given earnings till here. Using that, can we arrive at the future maintainable profits and then arrive at the value? Yes, simple. So solution. Very good, students. All of you are correct. Unit 1, and this is unit 2. So let's first of all start with the reported profit after tax. How much it is? 147 and 140. So first of all, we need to do this profit now before tax, right? So this we need to do PAT divided by 1 minus tax rate. Okay. So this becomes 147 divided by 1 minus 30%. Similarly, 140 divided by 1 minus 30%. 147 divided by 0.7. So this becomes 210. And this one becomes 140 divided by 0.7. 200. We are putting rupees crores here because the numbers are in rupees crores. Okay. Now, students, these values includes extraordinary gains and losses. So we have to remove them. Minus extraordinary gains plus extraordinary losses. Gains are how much? 16 and 8. And these are already pre-tax. So I am not reducing or I am not adjusting for tax in this. Okay. Extraordinary losses is 20 and 12. How much it becomes? This becomes 214 and this becomes 204. Then plus profits from new product. Because the new product that has been launched will give us incremental profits. 56 and 12. This is 216 and this is 270. Okay, so PBT becomes 270 and 216 less tax on above at the rate 30%. So 270 into 0.3, 81 rupees tax will be deducted here, and 216 into 0.3, 64.8 will be reduced from here. So the future maintainable profit after tax will be 189 and 151.20. Correct, students? Now the PE ratio is how much? 10 and 12.5. So 151.2 into 12.5. This gives us 1890. This is the value of the units. And this will be 189. Okay, let me put it how I have calculated. 151.20 into 12.50. Similarly, 189 into 10. So this also becomes 1890. Yes, Jyoti, your answer is correct. Coincidentally, the value of both the units is coming out to be the same. Clear, students? Now, the price at which units can be diversified is calculated. Second part, the unit which can be divested so as to minimize the borrowings from the market. Now they're asking us that which unit will you prefer to divest? Come on, students, tell me what is your hypothesis, or let's say what is your understanding saying? See, the value is same. The value is same. Which unit do you think should be divested? Should we look now? What are the other parameters? The other important parameter is PE ratio. Higher the PE ratio, better it is. Lower the PE ratio, it is not, it is disadvantageous. Okay. So we will go with the P ratio now as a second step because the value of the units is same. Had the value of units been different, we would have decided in some other way. So P ratio for unit 1 is 10. Hence, we are good to divest unit number 1. Jyoti, just check once. It won't be unit 2, it will be unit 1. Unit 1 can be divested as it has lower PE. And last part is the amount of borrowings. What is the total requirement? 2000 crores. Amount of borrowings is equal to 2000 crores minus 1890 we will finance by selling this unit. What is the amount that is left? 110 crores. Clear, students? Yes, Suraj. First unit should be divested. Yes. Perfect. I hope till now we are able to understand how valuation principle works, what are the different methods, their practical applications till now, right? And the usability. Okay. Because in the first two questions itself, we have covered four different types of valuation methods. We have covered PE method of valuation, we have covered dividend growth model, we have covered realizable value, and we have covered the book value method. Now let's move to question number 3, students. Fragrance Limited has reported a net operating profit after tax to capital employed as 2.5% plus weighted average cost of capital for the year ended 31st of March 2021. Economic value added is rupees 4 crore as on 31st of March 2021. You are required to calculate the amount of capital employed, Net operating profit after tax if WACC is 10%. So students, before this, we need to understand the concept of EVA, which is called as economic value added. This is a very, very important topic, students. Practically, this is used for a lot of things. Now, what is EVA, students? EVA has a very simple formula and a very simple application. Okay, let me just take you through what is EVA exactly. EVA is equal to NOPAT minus WACC into invested capital. Or we also call it as EVA is equal to NOPAT minus capital charge. Or we also take it as EBIT 1 minus tax minus capital charge. Okay, now just hear me out, students. The economic value added is, okay, let me first also define what is NOPAT. NOPAT is net operating profits after tax. So students, if you see, I have invested, let's say 1 crore rupees in a particular business. Okay. Now, basis my expectation, which is weighted average cost of capital. As I told you, WACC is what? WACC is the expectation from the investor side. So basis my expectation, my WACC on this 1 crore rupees is how much? Let's say 15%, 1 5. So that means at least I need to satisfy my expectation out of this 1 crore investment to the tune of 15 lakhs, 1 5, right? That is what my capital charge is. That is what the bare minimum expectation of the shareholders and debt people is. Because WACC, I will take a weighted average, right? What is NOPAT? NOPAT is the net operating profit after tax. Now, if I tell you that by investing that 1 crore, I am able to earn 30 lakhs, okay, from the business. So net operating profit after tax means the business profits. Net operating. So operating will exclude what all things? Operating will exclude all your one-time adjustments again, your interest cost, because net operating profit after tax will not include any interest charge or similarly interest income, because interest income is not generated by business. Interest income is generated by the assets, sorry, by your investments that you have done. So net operating profit after tax means that you just take whatever your business is helping you to earn and you reduce tax from that, which is again I have denoted as EBIT into 1 minus tax. Earnings before interest and tax, if you adjust tax, sorry, in that you will arrive at NOPAT, which is net operating profit after tax. I hope it is understood. Now, since WACC also includes the interest cost element, how? Because as I told you that WACC is the weighted average cost of capital, which also includes cost of debt and cost of equity in a weighted average manner. So since here also the capital charge is on the overall capital, we have not excluded interest from the NOPAT. We have included interest here as well and in the capital charge as well, just to give us the overall EVA. On the overall investment, what is my EVA? Understood? Why are we not adjusting for interest? Okay. And why are we taking only operating profits? Because that is what my future maintainable profit is, or that is what the real performance of the business is. Why are we taking after tax? Because tax is something that goes hand in hand whenever I earn from business. So that is my business cost, right? Cost of doing the business. So hence I have reduced tax from the for calculating the EVA. So whatever is extra I am able to earn over and above the capital charge is called as economic value added, students. Yes, Jyoti, you're right. Capital charge is the amount which is not given, but let's say expected by the shareholder and debt holder. Okay. Whatever they will expect, that is the capital charge, students. Clear? This is a very, very important topic, students. EVA in practical life is also used to a greater extent. Okay. Now, EVA is clear here. So can we first write the formula? Net operating profit after tax minus WACC into capital employed. So this one that we mentioned here, invested capital is also means capital employed. Okay. Understood, students? Invested capital is also called as capital employed. Whatever capital I have employed. Perfect. So there is one more information that has been given to us. So we have to break down the first line item that is given. Fragrance Limited has reported a net operating profit after tax to capital employed. So let's just follow what is mentioned here. Net operating profit after tax divided by the capital employed is equal to 2.5% plus weighted average cost of capital. Okay. So what they're trying to say is that NOPAT divided by capital employed is equal to 2.5% plus WACC. This is the equation number 1 that they have shared with us. Now for NOPAT is equal to 2.5% plus WACC multiplied by capital employed. Can I write NOPAT is this? Yes. Okay. So 2.5% plus WACC whole multiplied by capital employed. Now let us use this NOPAT and substitute the NOPAT in this EVA equation. So first of all, students, EVA will become NOPAT. If I substitute, it is 2.5% plus WACC multiplied by capital employed minus WACC into capital employed. Correct? So only NOPAT we have substituted with this amounts. Now let us put amounts wherever these are there. So we have been given EVA is 4 crores is equal to 2.5% into capital employed. I have opened the brackets now, right? Plus WACC into capital employed minus WACC into capital employed. Students, can anyone tell me what would be my next step now? I don't know what is WACC. I don't know what is capital employed. I can actually cross this out. Plus WAC into capital employed minus WAC into capital employed. So this becomes capital employed becomes 4 crores divided by 2.5% students. So 4 divided by 2.5%, it is 160 crores. So capital employed becomes 160 crores. Clear, students, till now? Capital employed is not 10 lakhs, Jyoti. Just check once. It's coming out to be 160 crores. Now, no PAT if WAC is 10%. So again, substituting in the same equation, EVA is equal to no PAT minus WAC into capital employed. Okay. So we know that 10% is WAC, capital employed is 160 crores minus no PAT is equal to 4 crores. So this becomes 4 crores plus 16 crores is equal to no PAT. Therefore, no PAT is equal to 20 crores. This is the second part answer. Yes, Jyoti and Mansha, your answer is correct. 160 crore is the right answer. So, clear, students? No PAT is 160 crore. Sorry, no PAT is 20 crores. Capital employed is 160 crores. I hope the topic is clearer now, students, and we are able to understand how the business valuation principles works, right? Be it asset-based models, be it income-based models, or be it cash flow-based models, right? And now with the add-on things such as capital asset pricing model, such as your economic value added, we have to do the calculations. Okay. So students, let's take a break here for 10 minutes. Let's again reconvene at 8:34. Welcome back, students. So we will start with question number 4. Yes. Question number 4, students. It says that Associated Advertising Agency just announced the current financial year's income statement reports its net income to be rupees 12 lakhs. So a point to be noted that we are talking about the current year's financial income statement, which is showing an income of rupees 12 lakhs. AAA's marginal tax rate is 40%. That means their regular tax rate is 40%, and its interest expense for the year was rupees 15 lakh. Okay. The company has rupees 80 lakhs of invested capital, of which 60% is debt. So out of 80 lakhs, 60% is debt, balance 40% is equity. In addition, AAA tries to maintain a weighted average cost of capital, which is WACC, near 12%. So they have been maintaining the WACC of 12%. Okay, students? Till now, the information is clear. Compute the operating income or EBIT AAA earned in the current year, which is very easy. How we can compute our operating income or EBIT? We have net income, which is as good as PAT. In that, if we add interest, we will arrive at EBIT, right? Or operating income. Calculation of operating income slash EBIT. So let us start with reported net income. We are talking about rupees 12 lakhs plus taxes. So 12 lakhs divided by, what is the tax rate? 40%. 1 minus 40% into 40%. 8 lakhs. So the profit before tax, 20 lakhs. So this is actually PAT. Okay. We arrived at PBT using this, which is 20 lakhs. Okay. From this, we reduce our interest. Sorry, we add our interest to arrive at EBIT, right? Which is how much? 15 lakh. So EBIT becomes 35 lakhs. Operating income or EBIT becomes 35 lakhs. Okay, students. First part is clear. Easy and simple. Students, you have any queries till now? Please answer. Sorry, please let me know what are those queries. I will answer them. In case you have anything which is unresolved or not known, please do let me know. B part. What is AAA's economic value added for the current year, which is EVA? This is also easy. Calculation of economic value added. So EVA is equal to NOPAT minus WACC into capital employed. Correct? This is called as EVA. Or in this case, can we use EBIT that we have already calculated? Can we use this? Yes, we can use this. What is the EBIT? 35 lakhs. 1 minus 40% of tax rate. WACC was told how much? It was told that this company tries to maintain a WACC of 12% into capital employed. What is the capital employed, students? 80 lakhs. Out of that 80 lakhs, there is a ratio that they maintain for debt and equity. That is a separate part, right? But the overall amount of capital invested is 80 lakhs. Okay. Because we have the overall cost of capital, which is WACC. Hence, we are using the overall capital employed. So this becomes 21 lakhs minus 9,60,000. So EVA is equal to 11,40,000 students. Clear? Economic value added becomes 11,40,000. Okay, thank you, Shailesh. Let's move to the next part. So first, the question had asked us to calculate EBIT. Then the question had asked us to calculate the EVA. Then the third part. AAA has 5 lakh equity shares outstanding. According to EVA value, you computed in part B. How much can AAA pay in dividends per share before the value of the firm would start to decrease? Very, very important, students. What they're saying is, according to the EVA value that you have computed in part B, what is EVA? EVA is actually the incremental earnings over and above what is expected by the investors. Correct? Be it debt holders, be it equity holders. So over and above whatever you have earned is maximum what you can pay as earnings. Then only your firm's value will not start to decrease, because the moment you pay higher, then your firm's value will start to decrease. The next part is, if AAA does not pay any dividends, what would you expect to happen to the value of the firm? Simple, it will increase. Why? Because the EVA is better, right? The EVA is higher. That implies that business is earning more than what is needed. So it will continue to earn more, then it will invest more, earn more, invest more, earn more, invest more, so that the future growth is going to be higher. Okay. Third part. So what is the maximum dividend? That is the third A part, right? So EVA dividend can be 11,40,000 divided by 5 lakh. 5 lakh is the number of shares. So it is 2.28 per share, students. So EVA dividend can go up to 2.28 per share. Till this level, the value of the firm will not start decreasing. Okay. Now the next part, if AAA does not pay dividend the value of firm is expected to increase because it will achieve higher growth rate as EVA is positive. In other words, the business of AAA is giving higher returns than the overall cost of capital of the company. Okay, students? Because see, the positive EVA is evident of this fact that we are able to generate higher return compared to what is expected by the investors. Right? That means whatever extra we are earning, that we will invest in the business. And again, by investing more, our growth will be more. Because in next year, the amount of NOPAT will become even higher than the current year because of the growth students. Okay, students, anything till now, please do let me know. We are through with question number 4 also. Then we will start question number 5. Okay, let's start with question number 5. Question number 5 says, the following information is given for 3 companies that are identical except for their capital structure. So, orange, grape, and apple. These are the 3 companies which are very much identical, but their capital structure is a bit different. How? Let's see. Their invested capital is 1 lakh rupees each. The debt to assets ratio is somewhat different. So that means they have a different debt composition. Since they have a different debt composition, their capital structure is also different. Okay, students, tell me, what do you mean by capital structure? What do you mean by capital structure? Tell me, students. What do you mean by the term called capital structure? What relevance does the word hold capital structure while we evaluate the valuation of that company, students? Come on, tell me. Whatever you think, please do write. Okay, very good. I have got certain answers. Suraj is saying amount of equity and debt involved. Jyoti, debt and share composition and capital employed. Very good. Debt and equity structure. Kusuma, Shailesh is saying equity and debt proportion. Very good. All of you are correct. So capital structure is the way we structure our capital needs in the form of share capital, in the form of debt, in the form of preference shares, or even in the form of the earnings, or let's say the reserves and surplus, because the reserves and surplus are again invested into the company, right? Gurram is saying capital structure means design the capital such a way that the equity return is maximum. Okay, Gurram, very nice. Mansha, weights to be considered while computing the capital structure. Yes, so capital structure in a way is your so capital structure is the structuring of how your capital will look like, how you want to finance it. Okay. Now the debts are having different amounts. Shares outstanding, these are the numbers. Pre-tax cost of debt. This is the pre-tax cost of debt. 16%, 13%, and 15%. There are different percentages of the cost of debt. Then cost of equity, students. Cost of equity is how much? 26, 22, and 20. Correct? So we have been given cost of equity, cost of debt, but this is pre-tax. Okay, we have to remember this is pre-tax. Operating income, which is EBIT, earnings before interest and tax, is also given to us. Net income is also given to us. Tax rate is uniform 35% in all the cases. Yes, so Shruti has also responded, means combination of capital, that is debt and equity. Very good, Shruti. I think all of you are correct. See, I mean, we have to just align our thought process with what is needed. Okay. So the tax rate is uniform 35% in all cases. Now, first of all, compute the weighted average cost of capital for each company. Now, this is a question for calculating WACC. First time we are calculating WACC. Can we calculate WACC? Yes. For calculating WACC, what all things we need? We need cost of equity and cost of debt, and the ratio of equity and ratio of debt. So let's go to calculation of WACC. Okay. We have three companies: Orange, Grape, and Apple, right? What is the total debt that we can tell? Total debt is not given straight away. We have total invested capital multiplied by debt assets ratio. Correct, students? This is the total debt. So this will be 1 lakh into 0.8. Another one will be 1 lakh into 0.50. Last one, Apple, will be 1 lakh into 0.2. So this becomes 80,000. This becomes 50,000. And this becomes 20,000. Then comes cost of debt. Post-tax. How much it is given? 16, 13, and 15, students. 16, 13, and 15%. Now, here comes the, sorry, this is pre-tax. It's not post-tax, this is pre-tax. KD pre-tax. Now, here comes the understanding. While calculating WACC, now tell me, students, while calculating WACC, will you consider cost of debt as pre-tax or post-tax? Come on, tell me, students. While calculating WACC, you have to consider cost of debt. Now, for considering that cost of debt, whether you will take it as pre-tax or post-tax, students, think and then answer. Tell me, students, is it pre-tax or post-tax? Manisha is saying financial structure is broader than capital structure. Capital include sources. Yes, Manisha, that is right. Now tell me, students, For WACC, should we consider pre-tax cost of debt or post-tax cost of debt? What do you think? Yes, very good. Very nice. Good to see everyone. All of you are correct. Mansha, Jyoti, Guram, Suraj, Shailesh, Satish, Kusuma. All of you are absolutely correct. I'm glad to see that all of you are giving the correct answers. So 16%. And so the reason, okay, now let me tell you the reason why we use post-tax. Because debt is used as a point of view from the point of view of leveraging our funds. How? Because in case of debt, the interest is deductible for tax purposes. And whatever you end up paying tax, from that, you are easily able to reduce your tax outgo to the extent of interest that you are paying. So in your overall capital structure, if there is a presence of debt, you will get benefit from that on account of tax savings on that debt component. Okay. Hence, we always take cost of debt as post-tax. That is logic number one. Logic number two, WACC is used in the calculation of EVA. In EVA, we start with no PAT, net operating profit after tax. So if left-hand side, which is before that minus sign, is also no, after tax, so the right-hand side, which is WACC into capital employed, also needs to be post-tax. Okay, so we always take cost of debt as post-tax. 16% into 1 minus 35%. 16 into 0.65, which is 10.4. Similarly, 13 into 0.65, which is 8.45%. Then 15 into 0.65, which is 9.75%. Yes, Suraj, you are right. Tax has to be paid on the first priority. So we have calculated the cost of debt post-tax. Easy. Then students, can we know what is the equity amount? Just now we calculated the debt amount. Can we calculate the equity amount? Yes, it's 20,000 because it will be 1 lakh minus 80,000. Correct? Here it is 50,000. 1 lakh minus 50,000. Then here it is 1 lakh minus how much? How much? 20,000. Correct? So this will become 80,000. Cost of equity is how much, students? Cost of equity is straight away given in the question if I'm not wrong. Yes. 26, 22 and 20. So WACC. Orange, grape and apple. So orange, we can just simply take 26% multiplied by 20,000 divided by 1 lakh plus cost of debt post tax is 10.40% into 80,000 divided by 1 lakh. Correct? Grape similarly will be 22 into 50, 22% into 50,000 divided by 1 lakh plus 8.45 percentage 50,000 divided by 1 lakh. Then last one is apple. Apple is 20% on 80,000 if I'm not wrong. Yes. Divided by 1 lakh plus 9.75 into 20,000 divided by 1 lakh. Clear, students? Just with the ratios, we have multiplied the respective weights. 13.52%, This becomes 15.225% and this becomes 17.95% students. Okay, so this becomes WACC. Now let's go to the second part, students. Compute economic value added for each company. Now this is easy, right? So second part, EVA computation. Let's again put all the three companies: orange, grape, and apple. Now, what is EVA, students? EVA was NOPAT minus WACC into capital employed. So, what is the capital employed? 1 lakh, 1 lakh, 1 lakh. Correct? WACC. Just now we have computed WACC, right? 13.52, 15.225%, and 17.95%. These were the WACCs. So capital charge, can we calculate? Yes. 1 lakh into 13.52%, 13520, 15225, 17950. WACC is 1 lakh divided by 1,80,000 to 0.26. No, Satya, wait. No, so Satya, okay, I now got your query. Satya is asking it should be 1 lakh divided by 1,80,000. Instead of this, it should be 1 lakh divided by 1,80,000. No, Satya, it cannot be like this. Why? Because the total invested capital itself is 1 lakh. It is not shareholders' capital. It is the total capital. Okay. Out of that, 0.8 is debt and 0.2 is equity. Okay. Now, capital charge we have computed. We have to compute EBIT 1 minus tax rate. What is the EBIT 1 minus tax rate here, students? EBIT is this. And from this, we have to reduce the tax rate, 26,600. So 26,600, 1 minus 35%, right? So this becomes how much? 17,920, 17,290, sorry. Okay, then similarly 16,575 is the next value and 16,900 is the last value. Okay. Now, EVA will be, let's say this is B and this is A. Okay. So A minus B is equal to 17,290 minus 13,520, which is 3,770. 1,350 minus 1,050. Very nice, Jyoti. 3,770 orange, grape is 1,350, and apple is minus 1050. Very good. Jyoti, your answers are correct. Okay, so orange, grape, and apple, the EVAs are 3770, 1350, and minus 1050. Now let's go back and see what is left in the question. Based on the EVA, which company would be considered for the best investments? Give reasons. The best company in which we can invest for the same amount of capital, this company is giving us the highest EVA, correct? So definitely we will consider orange would be considered as best investment since EVA of the company is highest and its WACC is lowest, students. If you see, the WACC is lowest of orange. So for the same level of business, the same level of investments, wherein it is also categorically mentioned that they are exactly same. All the three companies are exactly same only because of their capital structure. Now see, if you see the reason also why their WACC is also lowest, that is because the highest percentage of debt is in this company, and the company is getting an advantage of the tax on the cost of debt, right? That is why it is higher. Then next, students, the fourth part, what is it asking? If the industry PE ratio is 11x, estimate the price for the shares of the each company. Also give your observation on using the same PE ratio to estimate the price for the shares of the three companies. So students, for applying PE ratio, we need to know what is the net income. Net income divided by the shares, we will arrive at the EPS. On that EPS, we will multiply the PE ratio to arrive at the market price. Calculation of share price. Again, here it will be orange, grapes, apple. Okay. So for these three companies, the net income was how much? That is given in the question, students, which is PAT, right? Net income is PAT 8970 12350 and 14950. Number of shares are how much? 6100, 8300 and 10,000. That is also given, right? So EPS effectively becomes 1.4705, 1.488, 1.495. Okay, the PE ratio is actually 11 times all across, right? So 1.4705. Now share price will be EPS into PE ratio, right? So 1.4705 into 11, correct? So this becomes 16.1755, correct? Then it becomes 16.37, 16.45. So here I'm just approximating this value also. 16.18. And there is one more subpart in this. What does it is saying is it justified to use the same PE ratio? Tell me, students. See, we have used the same PE ratio. Is it justified? Is it justified to use the same PE ratio? We think it's not justified. Reason being, all of them have different capital structures. And hence, somewhere the advantage of leveraging the debt is more. And somewhere the advantage of leveraging the debt is less. Similarly, the presence of debt in a particular company's financials indicates risk, the risk of non-payment, the risk of delayed payment, right? So we cannot take the same PE ratio. What we can say is, since the three entities have different capital structure, they would be exposed to different degrees of financial risk. As I told you, higher debt means higher risk. Although your cost of capital is coming down, but it implies that you are operating on a higher risk, the risk of non-payment or delayed payment, students, correct? Financial risk. The P ratio, therefore, should be different. Should be adjusted for such risk. Okay, students, I hope this is clear. Okay, Jyoti is asking, in this question, if net income was missing and we need to calculate PAT from EBIT, right? So to reduce interest on debt, we will use pre-tax cost of debt or post-tax cost of debt. So Jyoti, we will use pre-tax cost of debt. Reason being, you will end up paying. See, what in your financials, how will you record your interest cost? Your interest cost you will record at the gross value, which is including the tax, right? So that is pre-tax. Then you will reduce that amount from EBIT to arrive at PBT. From that PBT, you reduce the tax at one go, correct? So you will use pre-tax cost of debt, not post-tax cost of debt. Prashant is saying why we consider lower PE ratio in question 2. What is that lower PE ratio in question 2? Let us go and see that once, Prashant, after this is over. Now, next part, calculate the estimated market capitalization of each of these companies. Now, they're asking us to calculate the market capitalization, which is simple. We already have the price per unit, market price per unit. We have the number of units of the shares, right? Then we can compute the market price, market cap. Market price, orange, grapes, and apple. So 16.18 16.37 and 16.45. Number of shares 6100, 8300 and 10,000. Estimated market capitalization. Right, so 16.18 multiplied by 6100. 16.18 multiplied by 6100. 98,570. 98,698. Even students, what we can do is we can just multiply the net income. What is 8970 multiplied by 11? Correct. So even the other way to do is we can just take the net income multiplied by PE ratio. So let's do that. So as to avoid any rounding of error, 98. Sorry, this was how much? The 60, no, sorry, 11 into 398970. 8970. This is 98,670. Okay, then second one is 12,350 into 11. 1,35,850. And the last one becomes 14,950 into 11. 1,64,450. Okay. So I've used net income into PE ratio, students. Yes, Mansha, your answer is correct. So I hope this question was also seemingly easy and lot of things would have got clarified to all of you students. How the capital structure will look like, how it will have an interplay with the market capitalization, the value of the company, the value per share, P ratio, all those things, and even the economic value added, students, right? Let's move to question number 6. ABC Limited has divisions A, B, and C. As the name suggests, A, B, and C are the three divisions. The division C has recently reported an annual operating profit recently, okay, focus on all each and every word, of rupees 20 crore 20 lakhs. The figure arrived at after charging 3 crores full cost of advertisement for launching a new product. So this 20 crore 20 lakhs is arrived at after charging 3 crores as cost of advertisement expenditure, which is for launching a new product. The benefits of this expenditure is expected to be lasted for 3 years. What they're saying is the benefit of this expenditure will last for 3 years. The cost of capital of division C is 11% and cost of debt is 8%. Clear, students? The cost of capital of division C is 11% and separately they have given you the cost of debt. The net assets of division C as per the latest balance sheet is rupees 60 crores. But replacement cost of these assets is estimated as 84 crores. Okay, so what they are referring is the book value is 60 crores, but today if I want to replace it, the correct value is 84 crore. Sorry, you are required to compute the EVA of division C. Easy and simple. Can we calculate the EVA of division C? Yes. Let's go step by step. First of all, what is EVA? NOPAT minus WAC into capital employed. Now, students, whatever information has been given to us in the question, let's put all of that information in this equation. So calculation of no part. Have they given us tax rate somewhere? They have not given us any tax rate. So let's ignore the tax rate because since we have not got it, so annual operating profit currently is how much? 20 crores, 20 lakhs. This is the rupees amount, right? 20 crores, 20 lakhs. Now, in this, 3 crores of advertisement expenditure is charged. This is charged. Okay. So this becomes 23 crore 20 lakhs minus advertisement expense for 1 year should be reduced from this. So minus 1 crore. Correct, because 3 crores is for 3 years. So 1 year has already passed. 1 crore should get reduced from this. Agreed? 22 crore 20 lakhs. This is the no PAT. Okay. Now, capital employed is actually 84 lakhs students. How much it is? 84 crore, sorry. Capital employed is 84 crores. Reason being, we are using not the book value, but the replacement value. Okay. Because the information is given and it is appropriate to base our capital employed basis this 84 crore. Hence, we are doing that. Okay. So how will you compute EVA? EVA will get computed 22 crore 20 lakhs minus 84 crores multiplied by what is the WACC? Now, should we take 11% students or 8%? Tell me. Answer this question, students. What is the right WACC to be taken? Is it 11% or 8%? It should be, yes, Jyoti, you are correct. It should be 11% because 8% is only cost of debt, which is not relevant here. Okay. Into 11%. So this is how much? 84 crores into 11%. 9 crore 24 lakhs. So EVA becomes 22 crore 20 lakhs minus 9 crore 24 lakhs. So hence EVA is equal to 12.96 crores. Make sense, students? Very good. Jyoti, your answer is correct. So this was a bit tricky question. I mean, see how facts can, be changed or modified to test your, let's say, understanding. Now in this, The only catch was, one, we have to use overall cost of capital, not cost of debt. And second was the treatment of provision for advertisement. Or let's say, sorry, the treatment of advertisement expense, which was incurred for 3 years. We cannot take that hit into 1 year. It has to be spread across 3 years for calculating the correct no PAT. Question number 7, students. Yeah. ABC company is considering acquisition of XYZ Limited, which has 1.5 crores shares outstanding and issued. Now, see, there has to be a context of some valuation, right? Then only you will do a business valuation. Now, here the context of the business valuation is really where the company is in the process of acquiring another company, and hence the business valuation needs to be done. So ABC company is considering acquisition of XYZ Limited, which has 1.5 crores shares outstanding and issued. Understood? The market price per share is 400 at present. ABC's average cost of capital is 12%. That means we have known what is the WACC of ABC. Available information from XYZ indicates its expected cash accruals for the next 3 years are as follows. So students, this is the first portion on one approach, which is the cash flow approach. Because if you see, they have given us the expected cash accruals. Cash accruals means whatever we are going to earn in cash for the next 3 years, which is 250 crore, 300 crore, and 400 crore. Calculate the range of valuation that ABC has to consider. Now it is asking for a range of valuation. What is the range of valuation? The highest amount and the lowest amount. The highest amount that ABC can pay to XYZ Limited, or the lowest amount that ABC can pay to XYZ Limited. So that means we have to value this business from two methods, right? Which are those two methods? Can anyone tell me? Basis whatever is given in the question, we have to apply two methods, students, right? What will be those two methods? Come on, tell me. Because then only we will be able to arrive at a range that ABC has to consider, students. Okay, let me tell. One is the cash flow based, and second one is the market price itself. Yes, Kusuma, Gurram, Jyoti, all of you are correct. Yes, very nice. So, the value as per market price is equal to how much are the shares? 1.5 crores are the number of shares. 400 per share is the value. So it becomes 400 into 1.5. So 600 crores is the value as per market price. Yes, Shruti, you're right. Then second is basis cash flow falling is the valuation year 1, 2, and 3. Rupees crore, this is the cash flow, right? How much it is? 250, 300, and 400. This is the rupees cash flow, right? Then we have the present value factors. Now, present value factors, students, will be taken from the ABC's point of view because ABC is evaluating what should be the right cost. So it will be taken as 12% from ABC's point of view, which is, these are also given in the question, 0.893, 0.797, 0.712. Yes, Jyoti, your answer is perfectly fine. Yes, very nice. So, present value of cash flows will be how much? 250 into 0.893. 250 into 0.893. 223.25. 300 into 0.797. 239.10. And then 0.712 into 400. So 284.80. In totality, this becomes 239.1 plus 223.25. 747.15. Okay, so the range, hence range for, this is which company? ABC company. Sorry, hence range for value of XYZ company is as follows. Minimum 600 crores, maximum 747.15 crores. So this is the value, right? Similarly, price per share. Also, I think we need to denote minimum, maximum, right? Minimum already we know it is 400, and for 747.15 crore divided by 1.5 crore, right? Divided by 1.5. So this becomes 498.1. So this is the minimum and maximum price that can be quoted, students. I hope this is clear, students. Perfect. So can all of you observe some issue with this question? Is this question, or let's say the value that we have calculated, is it complete? Or there is something that you feel is missing? And if yes, then what is that? Without which the valuation seems incomplete. Come on, tell me, students. What do you feel? Is this value calculated appropriate? Solution is done. Solution is this much only, but I'm just checking on one inherent thing in the question. Do you feel something also needs to be adjusted to arrive at the right value? Tell me, students, come on. These all things will firm up your understanding, students. Yes, students, tell me, is there something else that you feel? Okay, very good. I'm getting some responses. Jyoti and Gurram have expressed their views. Rest all, please also, quote. Okay, let me tell. There is no terminal value in this, students. Okay, very nice. Suraj, Gurram, good try, students. Good try. Keep trying. However, there is no terminal value here. Is the valuation complete without terminal value? How can you really value a business by only next 3 years cash flow? You can't, right? So that is what I was trying to tell you. Although it's not given, we will still go ahead with what is given in the question, but terminal value should also be there. Question number 8, students. Eagle Limited reported a profit of rupees 77 lakhs after 30% tax for the financial year 2011-12. Got it? So what they're saying is there is a company called Eagle Limited reported a profit, which is net profit after tax, 77 lakhs. 30% is the tax rate and 11-12 is the financial year which we are talking about. An analysis of the accounts revealed that the income included extraordinary item of rupees 8 lakhs and extraordinary loss of rupees 10 lakhs. The existing operations, except for the extraordinary items, are expected to continue in the future. See, they have given you the definition of future maintainable profit also. So they are saying that barring these extraordinary items, rest all things we expect to continue in future. In addition, the results of the launch of a new product are expected to be as follows. In addition to this, they are saying that there are some new products that are expected to be launched for them. These are the details. They are expecting a sales of 70 lakhs by incurring a material cost, labor cost, and fixed costs that are given here. Okay. You are required to calculate the value of the business given that the capitalization rate is 14%, students. Now tell me which approach, asset, income, cash flow. First of all, tell me from these three which approach we should use. Students, tell me. We have been given certain set of information and they have not told us to apply which method. What is our analysis about the question saying which approach we should use? Is it asset based? Is it income based? Or is it cash flow based, students? Very good. Mansha, Jyoti, Kusuma, Satish, all of you are correct. Now within income also, we have studied two techniques. Tell me which one to use within income. We have studied about two techniques, students. One is PE, second is capitalization rate. This is a question on capitalization rate. Correct? So we will use this technique in the capitalization rate. So let's start with the solution. Yes, Gurram, Suraj, Prashant, Satish, Kusuma, Jyoti, Mansha, all of you are correct. So computation of business value. Okay. So we will start with profits after tax. Rupees in lakhs. Profit after taxes 77 lakhs. Add tax. So 77 divided by 1 minus 30% is the tax rate into 0.30. Correct? This is how we will calculate the tax value. So 77 divided by 0.7 into 0.3. It is 33 lakhs. By adding tax, we will arrive at profit before tax. Is 110 now, right? Now, what all adjustments we have to make in the students? First of all, there is an extraordinary item of income 8 lakhs and loss of 10 lakhs, right? So reducing extraordinary gain plus extraordinary losses. Gain is how much, students? 8 lakhs plus 10 lakhs of losses. 110 plus 10 minus 8, 112. Correct? 112 is there as is stated, profits before tax. Now in this, students, we have to add income from new product. What is the sales? 70 lakhs, correct? Material cost 20. Labor cost is how much? 12. And fixed cost is 10. So 70 minus 20 minus 12 minus 10. This is around 28. This will get added 212 to make it 140. So the future maintainable profits before tax is equal to 140. Jyoti has given the value of business also. Very good, Jyoti. Now, should I apply on this 140 students the capitalization rate of 14%? Or is there something else also that I have to do? Come on, tell me. Should I have to apply 14% capitalization rate on this to arrive at the value? Or is there some adjustment I'm missing? Come on, students, tell me. What do you feel, all of you students? Tell me. Because I just don't want this to be one way. Hence, I'm asking a lot of questions, students, so that all of you are also engaged. Yes. Very good. Kusuma, Jyoti, Satish, all of you are correct. We have to reduce the tax minus tax at the rate 30%. 42 becomes the tax rate, right? So minus 140 is equal to 98. Yes, Prashant, Mohammed Abdul Rahim. Yes, tax has to be deducted. Very good. So the value, oh, first of all, future maintainable profit after tax is equal to 98. Capitalization rate is actually 14%, and hence the business value becomes 98 divided by 14%. 98 divided by 14% is equal to 700 lakhs, right? Very good. I think Kusuma has given the next part answer also. No worries. So this is a 700 lakhs, right? So where finally we can say value of business is equal to rupees 700 lakhs. Clear? Okay. Once you copy, then we will move to the next part. The next part, students, it says that determine the market price per equity share with Eagle Limited share capital being comprised of 1 lakh 13% preference shares of rupees 100 each and 50 lakhs equity shares of rupees 10 each, and the P ratio being 10 times. Now see, students, in the second part, they have clearly given us the additional information which will help us in identifying the market price per equity share with the help of this P ratio, right? Now, how should we do? We have been given the preference shares also. So there will be a preference dividend on them. We understand that the P ratio needs to be multiplied with the EPS, but that EPS has to be post preference shares dividend. Then only we will be able to arrive the pure play equity related value. Correct? So let's start for the second part from future maintainable profits after tax of 98 lakhs. Future maintainable profits after tax of 98 lakh rupees. Correct? less preference shares dividend. Okay, students, let's preference shares dividend. How much are the preference shares? 1 lakh. What is their face value? 100. And 13% is what we are going to pay them the preference dividend. Okay, so this comes out to be 13 lakhs. Please remember, students, there is no tax adjustment required now in this, right? Only profits are after tax, but the dividends that we are paying, there is no tax adjustment required there. Okay. Had it been interest, then we would have taken the tax adjustment on interest. So it becomes 85 lakhs. So this is earnings available to equity shareholders, right? So if 85 lakhs is the earnings available to equity shareholders and we have to arrive at the market price with the PE ratio, the next step should be we have to calculate the EPS now, right? Earnings per share. So for calculating EPS, we have to divide by the number of equity shares, which is 50 lakhs. Correct? So earnings, sorry, I should not put bracket here. Earnings per share becomes 85. There is some issue. 85 lakh divided by 50 lakhs is 1.7 per share. And clearly in the question, we have been given PE ratio, right? So the PE ratio is how much? 10 times. And hence the market price per share becomes 17 rupees. Understood? Okay, students, I hope this is clear. Any questions? Okay. Jyoti, sorry, Satish and Jyoti, your answer is correct. Jyoti, 12.8, are you referring for the above value? So Jyoti and Satish, both of you are correct. Okay. So I hope question number 8 is clear, students. Again, if you see in this question, there were two different approaches, right? One is the PE approach, and second one was the capitalization rate approach, right? Perfect. So let's just, students, revise for what we have discussed in this today's session. So students, we started our discussion on business valuation by revising some of the concepts that we would have already studied till now. So in that we discussed about present value, internal rate of return, ROI, then one of the very important formula of Gordon's growth model for dividend, wherein we said that dividend expected to be paid in the next year has to be taken for the current business valuation or the current share price valuation. And cost of equity and growth also have to be calculated for this formula. Terminal value, students, we said that terminal value is very important because For using this, we value the perpetual amount that is going to come after the explicit period. We discuss what do we mean by explicit period and terminal value. Then students, we also studied about the weighted average cost of capital, where we said that the respective cost of equity, debt, and preference shares needs to be taken in terms of the weights and calculated the WACC. Here the catch was that debt always needs to be post-tax, correct? Then we discussed about the different approaches to value an enterprise. What were they? The first one was asset-based, which is a balance sheet approach that we discussed, right? In asset-based approach, now the second question was that what is the right value of those assets to be taken? We said that there are three ways you can take within asset approach also. One is that you can take the current book value, which is the net assets value, which is again a historical cost, or the book value at which the assets are appearing. The second approach was the net realizable value, which is also called as the liquidation value or adjusted book value, in which whatever price we are going to realize for such assets, we will take that as the value for asset-based approach. Third one was replaceable value. If the same standard of machinery or asset, we replace it today for the same balance useful life, for the same conditions, what will be our replacement cost be? And hence, taking a asset-based amount basis the replaceable value, students. We did a lot of questions on the asset-based model today, right? Similarly, on the income-based approach, we said that, sorry, for the asset-based approach, what was the drawback? The drawback was that it only takes into account the historical transactions that has happened. It is not taking into account the futuristic ability of the company to earn profits, or let's say the futuristic ability to generate the value for the business. So that was eliminated through the use of income-based approach and cash flow-based approach. In income-based approach, we calculated, first of all, the future maintainable profits, in which we discussed in the questions today that future maintainable profits has to exclude all the extraordinary gains and losses, and it has to include any new product related income that we are planning to make in future, or any other adjustment from a futuristic standpoint that is given in the question. For example, that advertisement expenditure, right? In one of the question, we adjusted for the advertisement expenditure. Then basis this future maintainable profits, we have two options. One is that we can use the PE multiplier, or we can use the capitalization rate. Now, just the previous question, the last or the second last question, we covered both these aspects, P multiplier and capitalization rate both, to arrive at the value basis the income-based approach. Then we also discussed about the cash flow-based approach, right? In our next session, we will do a lot of questions on cash flow-based approach as well to form up our understanding. And here we said that we use the discounted free cash flows, right? Free cash flows were cash flow from operation minus capital outflow that we will discuss later. And I think from another concept point of view, we also discussed about EVA, which I said is a very important concept from the practical aspect as well. What was EVA? EVA was economic value added, wherein we said that how much incremental business is able to give us over and above what the expectation of the investors is. By investors, we mean both debt and equity holders. So here we said that we will take NOPAT, which is net operating profit after tax. So in this, tax is reduced at the operating income. Okay. And interest is added, because we say that in capital charge, we are also taking interest equivalent cost of debt. And hence, EVA became the incremental amount that the business is contributing, students. Okay. We did questions today on EVA as well. So question number 3 and later on, we have discussed about the EVA. So students, this brings us towards the end of the session. I request CA Ashish sir to please help with the concluding remarks.
Thank you, Devas.
Thank you, sir.
Am I audible? Am I audible, Devas?
Yes, sir. Yes, sir. You're audible, sir.
Good morning, Devas. Your session was very and knowledgeable.
Thank you, sir.
Because student, this session, this is a topic of business valuation is very important because there are some reasons. See, if you see the sequence of our chapters, it precedes the topic merger and acquisition. Okay, so for any merger and acquisition, it is a prerequisite. See, for merger and acquisition, there are two valuation types of required. Normally, share valuation that we have done in the security valuation topic. Then another is overall business. Okay, when we carry out the business valuation as an overall business, so it will also helps to making the business decision, merger acquisition decisions. Another very important aspect of valuation is like a valuation of for the valuation of ESOPs. ESOP for the ESOP valuation also, the valuation of business plays a very big role. And nowadays, one another important aspect has come out that is for the divorce proceedings. Now, whenever any big business houses and divorce taking place, so it is also mentioned that how much going value of the business is giving in alimony, like all alimony like this thing. And another very important aspect of the valuation this topic is performance evaluation. Now, Divas sir has discussing about the EVA, that is economic value added. Student, I would like to throw some light on this. Basically, it is not very old topic, rather it is a latest topic, or we can say somewhere around in 1990s it has come out. Now, this topic has been developed by the consulting firm Stern and Stewart and company. They are management consultant. They have developed this concept. The purpose of this developing the concept is to evaluate how much a business is earning over and above its cost of capital. That is called economic profit. Now, if it is they are earning positive, if EVA is positive, it means they are the value creator. Okay, management decisions are value creators because from this we evaluate the performance of the management also. If it is EVA is positive, it means management is performing well. If it is negative, of course, it is a value destroyer. So it means management is not performing well. So this can also be used as a performance. However, if we see in isolation, EVA cannot be used as a basis of valuation of shares. However, they can be used to appraise. They can be, you can say, uh, they can influence the shareholders' decisions to buy the share or acquire the share only. So there are some can this kind of a thing. And of course, EVA is very useful, but it also suffer from some limitations. Now, of course, these limitations are there, but these limitations can be overcome by the market value added method that will be discussed in next class. Devasar will take up this in next class.
Yes.
Another thing important, student, of course, this is a part of the what I have want to say about this EVA. Now, another when I was quit last time, I think one or last or another time, second last time, when I was just logging out, there was one student sent the query. I'm not remember his name. They were saying, sir, is the assignment questions are sufficient for the for examination one? So my request to you, student, again and again, I'm telling you, of course, these questions have been compiled from the various ICAI publication. But my request to you, please don't ignore the study material at all. You are requested to cover each and every question. Of course, it may have covered in your study material as well. But if any question has not been covered in your study assignment, so any question it is study material, but it has not been covered in your assignment, so please do it thoroughly. Even as illustrations, you have to go through properly. And my request to you, even you can refer MTP, mock test papers, TP, etc. Whatever publication I say available, you can refer the same on available on the website. So, student, with this, we come to the end of the session. And Devas sir, as a practice, just
Yes,
write
sir.
down our contact number. Student, you can send the queries at mobile app.
So it is 012030
3045 956.
956.
Okay, students. So this is our contact number. You can contact us. And student, with this, we come to the end of the session. Devas sir, thank you. Thanks a lot for
Thank
sparing your precious time and throwing the light and lighting the student on this very interesting topic, valuation. And student, I also thank you for patiently listening in the 3 hours discussion. And we shall continue discussion on this topic in the next class. Okay,
Yes, sir.
student, have a nice day. Okay, Devas sir, have a nice day.
Thank you,
Thank
sir.
you.
Have a nice day, sir. Have a nice day. Thank you, everyone. Thank you.